My name is Jake, welcome to the channel. In today's video, we're going to talk about core and satellite investing, and most particularly how it pertains to dividend investing. If you're a new dividend investor and you're thinking about building a dividend portfolio, you're probably going to have a lot of questions. Well, I know that I did years ago when I was first trying to build a portfolio that was going to pay me passive income so that I didn't have to rely on my active income and my day job. I wish I would have seen a video like the one I'm going to make today years ago. It would have helped me so much. 5 years ago when I was first thinking about this whole idea of living off of my dividend portfolio. And I want to share some thoughts with you today. If you're maybe newer, or if you've already started living off of your portfolio, or whatever stage you may be in, I think this video is going to help a lot of you that are maybe newer when thinking about building and constructing a dividend portfolio. So today's video, we're going to talk about three things. We're going to talk about core and satellite investing. Most particularly, I'm going to look at the Vanguard's guide to this. Second, I'm going to go and show sample portfolios based off of time horizon, because a lot of this has to do with your time horizon, how you construct a portfolio. If you haven't seen my video on how to invest based off of your time horizon, I will leave a link in the top right. You can check that out. And then the last thing here, the third part, is I'm going to show you how I use the core and satellite investing approach with my portfolio. So I'm going to actually go through and show you what's going through my mind, how I'm modeling it, and some of the things that I'm looking out for. And it may be interesting for you, whether you have a long or a short-term time horizon, just to kind of understand how maybe somebody else is doing this and take away things that you like and, leave behind what you don't like. But yeah, anyways, this is a very nerdy topic. I mean, look at the first topic here, investing theory, right? Like we're talking about investing theory on a Sunday. So I think needless to say, we're going to need a lot of enthusiasm and motivation for this video. And I think, there's no better way to get the blood pumping. And it could look a little like this. Oh my gosh. Oh, I love it. All right. So if you love memes as much as I do, I'm on Instagram. You can go ahead and you can follow me there. I love doing just random weird stuff. If you're weird like that and you want to follow me on Instagram, I will leave a link in the pinned comment below. There's some, oh my gosh, like what is this? Oh man, I'm weird. Anyways, let's talk about core and satellite investing. So the guide here that I'm going to be looking at is from Vanguard. So bear in mind that some of this is going to be skewed a little bit more towards the perception or perspective from Vanguard. Now, the core and satellite model itself is pretty straightforward. You have your core portfolio and you have your satellite portfolios. Anyways, let's take a look at this. Let me go ahead and zoom in here. Let's see if you can see it here. I want to just read this off. I think it's easier for me to do that than just kind of summarize. So core and satellite is a powerful investment approach. The core and satellite concept is a portfolio philosophy that combines the best of portfolio theory and real-world market-tested approaches. So it's looking at what really in theory should work based off of different modeling, as well as what's actually worked in reality when it comes to individual investors investing in this type of strategy. So in essence, the core and satellite is a common sense investment approach. I love it because it's just simple and easy to understand, which combines the benefits of index funds, meaning low cost, broadly diversified indices, as well as tax efficient with lower volatility, with an actively managed fund or funds of other direct investments. So essentially, the passive indexing part of this is the core, and then the actively managed is the satellite approach. So with Vanguard, you're mostly going to get index funds or actively managed funds. If you were to ask or do another Google search, maybe you would have a different, way of looking at it, where it's not just ETFs or index funds. It could be individual holdings. It could be commodities, different asset classes, international. Like there's a lot of different ways that you can look at this. So going on here, the core and satellite approach brings greater discipline and stability to an investment portfolio buy. So these are the benefits of it. It reduces the reliance on picking the winners or chasing fund manager returns. So I'll give you a really quick example. ARK from Kathy Wood. If you would have last year back tested the performance of ARK and saw that it was up 100%, you would have thought, oh, this is the best thing since sliced bread. I have to invest all into ARK. Well, what's happened today, right? If you look at those funds, they're down 60, 70, 80% in some cases, or those thematic ETFs, right? So it's not a matter of chasing returns and picking the winners, right? You can't pick, everyone can't just pick Tesla or the Teslas of the world. It's not looking at that. As well as providing greater portfolio diversification. Once again, the theory here, the Bogle theory here is you can't pick the winners, so buy everything, right? So that's the theory behind it. And then potentially improving after-tax returns by taking maximum advantage of capital gains discounts, okay? And then reducing overall fund management and transaction costs, so this being the expense ratio. So this is at a high level what core and satellite is, some of the benefits, the core piece being passive, the satellite piece being active from a purely index investing approach. All right, so let's scroll down here. There's a few slides here that I wanted to share with everybody that I thought would be interesting. So this is the first one. So when you think about core and satellite, the active approach that I was just talking about comes with higher costs, higher risk, a lot of times because it's looking at past performance, right? There's more volatility and it's less tax efficient. Whereas with the index approach here on the right, it seeks market returns. So the index, right? The S&P 500, for example, or international or whatever index. You're looking at lower costs, lower management fees, lower risk. It's more focused on long term, and it's tax efficient. Okay, so that is in theory what the core and satellite approach is. And now let's take a look at some of the benefits. And now some of this is going to be kind of repeating, but once again, the benefits, the low costs, the tax efficiency, as well as you're going to get competitive long-term performance. You don't always have to pick the winners, right? You're picking the index, and then portfolio diversification and reduced personal risk. Okay, so those are the key benefits of following a methodology like the core and satellite approach here. So when it comes to the actual modeling of how you model your core and satellite, or what makes up different sections of the core or the satellite portfolio, it really comes down to you and your goals. But in theory, this is what it generally would look like, right? So the red being the index piece, and within the index piece, it's not just one ETF. You could have a fixed income ETF, you could have a treasury ETF, you could have a growth ETF, international ETF. Like it could be thematic, but the approach is the core it's passive, whereas the satellite is more active. Okay, and in an active approach, it could be, you're trading or swing trading. It's more short term. And so that is, in a nutshell, what the core and satellite investing approach is and the methodology behind it. And now what I want to do is I want to go into what this means, or how a dividend investor could approach their portfolio or construct a portfolio based off of the core and satellite investing model. So in order to do this, I'm going to make this really easy, and I hope that the majority of you watching this video have already seen that video, how to invest based off of your time horizon, because this really follows, it's kind of an addition to that. So if you haven't watched that video, I'd highly recommend you watch that. It'll make a lot more sense, because there's thousands of you that are watching this video, and every single one of you are in a different scenario, a different situation. You might be in your 20s, but you're looking to retire in 5 years. You might be in your 20s, but you're looking to retire or reach FIRE or financial independence in your 50s or your 40s. And so that is why understanding your time horizon really precedes everything else when it comes to how you're constructing your portfolio. But for the sake of simplicity here, I want to just make a few assumptions and just make it very general. Okay, so what I want to do is I want to say, okay, there's maybe somebody that's in their 20s or 30s watching this video. And you might be thinking, well, Jake, I have 20 years or 25 years. how could I adopt this method of the core and the satellite approach? Okay, and I want to really dumb it down, make it really easy, and give a few examples of where you could start. That's the key thing here. This is not the one and done, like don't copy this and then put all your money in it. That's not the intention here. I hope that this will give you a starting point of how to look at this if you're in this criteria of 20 plus years when it comes to your time horizon. So let's take a look at this first portfolio for 20 plus years. The way that I have it set up as an example is you can have your core be the S&P 500. Right? The index is really what you're banking on. What do you want your core to be? It could be an index like the S&P 500. It could be the total U.S. stock market. It could be the total world market, right? You could go and purchase one ETF and get the entire world, right? It really depends on what index you want to make up your core. And once again, the core is passive, right? It's a passive index. And you could use the S&P 500. I really like the Morningstar, dividend growth here from iShares, DGRO. You could take a look at the Dow 100 index, and with SCHD. You could look at the VYM, as an example, and you could overweight in these passive indexes as your core. Okay, as your core. You can be an individual stock investor while still having index funds. It doesn't, like, this is what drives me crazy, everybody. When I first started learning about dividend investing, I love PPC Ian. I love him. I started watching him over 4 years ago. I love Ian. But what really frustrated me was I thought that I could only had to pick the winners and I could only pick individual stocks. And that really messed me up. And I wish I would have understood that it doesn't have to be all individual stocks or all ETFs. You understand? By adopting the core and satellite investing approach, you can have a mixture of both. And that's what I didn't understand when I first started learning about dividend investing years ago. I thought it had to be all or nothing. Okay? And so I hope if you're early to investing and you're watching this and you're listening to what I'm saying, it doesn't have to be all or nothing. That is where a lot of my stress came from, was thinking I had to pick the winners. I had to pick only Teslas. I had to pick all of the winners and couldn't pick the losers. And that really caused a lot of anxiety in building this portfolio. And that's not what this is about. Okay. So that's why I love this approach. You don't have to pick the winners, but that's why the satellite positions are there. If you want to have individual stocks, or if you want to have thematic ETFs like the ARK ETF or whatever thematic or whatever ETF as an active investment, go for it. But your core is what doesn't really change, and the core is focused on long term, whereas your satellites are maybe a little bit short term. Okay, so this is an example of a portfolio with a 20-year time horizon. What you'll notice is the dividend yield is much lower, right? Because you don't want to focus on paying the taxes today, unless it's in a tax sheltered account like a Roth IRA, but then you're limiting when you're going to have access to this portfolio, right? You're going to be 59 and a half. If you have a long-term time horizon, the dividend yield is not as relevant because you're going to be paying taxes on that, and the dividend is only part of the total return. Okay, so this is an example of what that could look like. And really quick, like, these are just examples. You could have commodities, you could have fixed income, you could have treasuries, you could have bonds, you could have farmland, you could have crypto, you could have, Michael Jordan basketball cards, like whatever it is that makes up your total portfolio, but it still follows the method of the core and the satellite. All right, now let's take a look at another example with the core and satellite of around 5 years. Now this is going to look different because in 5 years, you're going to be looking to live off of the dividend much sooner. And so that's why you're going to have a bit of a higher dividend yield. Okay, so as an example, once again, this is just an example. Don't just go and blindly copy this. This is just an example of what you could consider, right? So for me, somebody that has maybe a 5-year time horizon, 5 to 10 years, having a core of SCHD, VYM, and DGRO, I personally really like that. You could have whatever indice you want in there, you can go to town, but the key thing is what you're putting as your core is the index. What index do you believe in? And it's not the ticker, it's not the brand, it's the index. Each one of these index, if you don't know the underlying index of these individual ETFs, that's where you got to start. I've shared videos on all three of these indices, and if you don't know what I'm talking about, go check out those other videos on my channel. If you go to my channel, I have a section dedicated just to ETFs. You can check those out. I've made entire videos on these. That's as an example, as a core. And then here, your satellite positions, maybe they're a little bit more skewed towards current income, right? You could have I bonds as part of your satellite position. You could have international stocks. You could have whatever it may be. But the key thing for me that I personally would advise here is don't have more than 5% in one individual holding or asset class. Asset class is maybe a little bit extreme, but just don't overdo it on your satellite positions. I'll give you an example. The whole process, the whole approach with the core and satellite is to reduce your risk. Don't go, in my opinion, go out and, you could have 80% in your core, then don't go and do like 20% into Comcast or 20% into GM or Ford, right? Spread it out. Okay, that's what I'm talking about when it comes to, spreading out your risk. You want to diversify a little bit. And if you did wanted to do that, like you want to have 20% into crypto, into Bitcoin, you can do that. But if you really want to adopt this approach of the core and satellite, you probably want to reconsider that and carve it out, right? Carve it out a little bit more. And spread it out. But that's just my opinion, just a few examples of how you could look at this. All right, now for the remainder of the video, what I want to do is I want to walk you through how I've set up my portfolio and some of the things that are going through my mind and how I view this concept of core and satellite investing. Okay, so part of this we're going to review in M1 Finance. Part of it I'm going to review in an Excel document that I'll share with you all. It'll be in the pinned comment below, as well as in Seeking Alpha. Okay, so the remainder of the video is just going to be showing you how I view this. And so in my portfolio, I have ETFs in here. I have cover call ETFs in here. I have individual stocks, some that are higher yielding but grow slower. I have some that are growing much quicker but have a lower starting yield. And so the key thing here, when looking at my portfolio, every company serves a purpose because what I'm aiming for is a portfolio average. Okay, let me say that one more time because it's the most important thing. Mind, the reason why I have multiple individual companies and they all grow at different rates is to achieve a portfolio average. And the averages are the current dividend yield and the dividend growth rate. Okay, those are the key things, and I'll show that here in Excel and walk you through what I mean there. Okay, but that's the purpose of why I have individual companies, and I personally like equally weighting them. I don't know if McDonald's is going to beat Honeywell in 20 years. And if somebody were to tell me they know the answer, I'm just going to nod and say, yeah, okay, all right, yeah. Nobody truly knows. Now, I could say with a degree of likelihood, well, Procter & Gamble is probably going to grow slower than, for example, Costco. As an example, I probably could say that Kimberly-Clark is going to grow slower than Pepsi. And I can make those general assumptions, okay? But the goal here is on the portfolio, the mix and the averages, okay? And we'll talk about that here in just a second. So now what I want to do is I want to get into some really nerdy stuff. Okay, so what you're looking on your screen here, it took me about 10 minutes to build this. And I'll show you here in a second how you can do the same. But essentially what I'm looking at is there's a lot of numbers here. So let me walk you through step by step what this is and how you can do it yourself. Okay. So first off, over here on the top left, I have January, February, March. My companies that I invest in, my ETFs, they pay on different schedules. Some pay quarterly, some pay every month. And so what I'm trying to do is understand once I reach my portfolio goal, which is over here on the right of $2 million, there's going to be a certain amount paid by each individual company or ETF. Now, I'm making a lot of assumptions based off of historical data, and I always throw out there historical performances never guarantee a future performance, but it's a good leading indicator. Okay, so it's not the one and only, it's just a good indicator. So top left, once again, this January, February, March, this is once my portfolio reaches its target weighting, this is generally what I can expect in monthly dividend income from the portfolio. And I'll show that down here in just a second. You can take a look at that here in a second. What this line is showing right here is the income that I'm going to be getting on a quarterly or monthly basis, right? And the way that I get that is I'm dividing the target amount of what I intend to have invested, the average 4-year dividend yield. Okay, I'm taking the average and then I'm dividing it by 4 because it pays quarterly. Now with this, for example, RYLD or with JEPI or whatever, it's doing the exact same thing, the target amount divided by 12 because it pays monthly. And that's where these numbers are from, okay? And then here you can see the schedule of when it's paying, right? SCHD pays quarterly, RYLD, JEPI, they pay monthly, and then, for example, Duke and so forth, they pay on their each individual schedule. This right here is the target amount. This is the amount that I want to have invested in each individual company or ETF, okay? These are the tickers of each individual holding that I own in my portfolio. Remember, I had 38. This should be 38. There's 38. This makes up, so I have two portfolios. I have the cash flow portfolio. I have the real estate portfolio. Each line here should equal 100%. So I have my cash flow and I have my real estate. And then here, this is the makeup of the total portfolio based off of a $2 million target and based off of the weighting in cash flow versus real estate, and then the 4-year average and the CAGR 5-year. Okay, so you might be thinking, well, this seems like a lot of work to do this. It only just takes a couple of minutes. Well, it depends on how you're gathering the information. Let me show you how you can gather the data here really quick, and you can do it for free actually here in Seeking Alpha. So in Seeking Alpha, you can build your portfolio in Seeking Alpha. You can link your brokerage or you can input it by hand manually. I just linked my M1 portfolio and it pulls up the dollar amounts, the number of shares, the yield on cost, like everything, the current yield that I have and everything. It's actually pretty cool. You can do that for free for one portfolio. You will need Seeking Alpha Premium if you want to do additional portfolios or if you want to access the grades, the dividend grades and everything. If you do want to sign up to Premium, I'll leave a link in the description below. You can get a year for $100. I do benefit from it. Seeking Alpha, I'm partnering with them. They do partner, they do support the channel here. And, but yeah, I just wanted to be transparent with that. But yeah, so anyways, once you have your portfolio in Seeking Alpha, this is the way that I do it. It took me like five minutes to do this, 10 minutes conservatively. What you can do is you go over here, and this is what I look at. I like looking at the 4-year average yield, because I'm assuming that the majority of you are dollar cost averaging into your portfolio. You're not lump sum investing. So if you're dollar cost averaging, I like taking the 4-year average because that is what you could reasonably assume will be the average going forward. It's not going to be perfect, but I like taking that versus the current yield. Okay. And then what I like to do is I like looking at the dividend growth over the last 5 years. You just gather the numbers here, the percentages. Okay. So now that we have all of the metrics here, now we understand what we're looking at. That was a long description, but there's a lot of information here. So now what I want to look at is I want to see, okay, what are my largest holdings? My largest holdings here are SCHD, VYM, DGRO, RYLD, QYLD, and then JEPI. This makes up about 50% of my overall portfolio. This right here, this is 50%. So this is my core, okay? Now, part of this is active, some of it is passive. These are actually more active. These are passive. But in a sense, what I look at for my personal core is indexes, whether they're active or index. Okay, so ETFs make up the core holdings in my overall portfolio, and then the other positions in my portfolio, Pepsi, or a utility or a retailer, they're going to make up the same weighted average of just over 1.5%. Okay, and then each of these holdings has a different dividend yield, as you can see here, and so each dividend payout is going to be different based off of the amount that I have invested, obviously, and the dividend yield. So when looking at this, there's really two scenarios. One, you have an individual who is dollar cost averaging into their portfolio for 10, 20 years, whatever time frame. They're dollar cost averaging. And so you have to use assumptions when you're looking at this. And so these are the assumptions that you could use. If you're retiring tomorrow and you know your dividend yield, you would put in your current yield and how much you have invested. And so then you would be able to see, okay, your dividend rate, your dividend yield, and your dividend CAGR. Okay, but for most of you watching my videos, I think it's safe to assume that the majority of you are dollar cost averaging. You're still investing. Okay, and so this is going to be helpful if you're thinking about this. You know, if you're dollar cost averaging $100 a week, $500 a week, whatever that amount may be, this is the starting point, and then you can project. Okay, once I have fully invested into my portfolio over the next 20 years. These are my target numbers. What will that potentially look like in terms of dividend income? And what it would look like is over here on the left. Over here on the left for January, February, and March, this portfolio is projected. It's not perfect. It's projected based off of these numbers, which will always change, okay? The reasonable assumption would be that once you've reached a $2 million portfolio with the current rates, you're going to have right around $75,000 annually in dividend income. Now, this $75,000 is based off of this, right? It's based off of the dividend yield, which will be going up and down. That's why we're taking the average. And so quarterly, that means you're going to be getting just around $1,900 every quarter, okay? And so when you're thinking about, well, you know, when I reach FIRE, I want to have equal distribution of dividend income. Well, this portfolio is not going to have equal distribution. It's going to have lower amounts in January, February, but larger amounts in March, in June, in September, and December, for example. So it's something that will help you mentally prepare when you're thinking about living off of your dividend portfolio in early retirement. Now, there's one last thing that I want to share with you that I thought would be really cool. So here, if you are using this spreadsheet, I share it for free. It doesn't cost anything. I don't have a Patreon. You can use it for free. I'm not here to sell anything. What you can do is there's a field down here, or there's a tab down here. It's going to pull up this screen right here. So I have a few other ones. So this one over here on the far left is assuming that you're dollar cost averaging, you're depositing, and you're reinvesting the dividends. This tab right here is you have all the money you're going to have, you're no longer reinvesting the dividends, and you're no longer funding the portfolio. Now, what I just said was my portfolio, using this example, has a 4% starting yield with an average of an 8% dividend CAGR. And if we put in my $2 million portfolio that I'm targeting, that's the target, hopefully we get there, based off of the portfolio percentages, I'm making an assumption of these numbers. Okay, and if you're not sure what these numbers are, go into the bottom down here and read the description and check those out. But assuming that the capital appreciation for the overall portfolio is around 5%, the dividend growth rate is around 8%. Now bear in mind, this is 100% equities. So this is actually fairly conservative based off of historical returns, which are never a guarantee, but that's what I'm working with here. And then the current dividend yield. What we're looking at is you can see, let me scroll this over here. You can see that the dividend income for this portfolio, once we reach FIRE, my wife and I, once we reach FIRE, the portfolio will continue to grow. Okay, the dividend CAGR is still pumping out more and more dividends each year, and they're growing year over year. And so you can see after 5 years, what was around $80,000 will now be over $108,000. After 20 years, it'll be over $340,000. And after 30 years, these big numbers hurt my brain. After 30 years, it's going to be $745. Now, these are just projections. I like to use conservative numbers, which I think these fairly are. But what this could potentially look like, let's say, for example, we had a lower dividend growth rate. Let's say we had a 4% dividend growth rate and we had a 5% dividend yield. What is that going to look like? Well, the dividends that you're going to be getting will actually be higher. right? You'll get more in dividend income if that's the model. So this is just a simple tool that you can use to forecast based off of your particular situation. And as I mentioned, everyone is in a different situation. Everyone has a different time horizon. Everyone has a different expenses, amounts that they can invest, etc. This is a tool that you can use to model and forecast based off of your particular situation. And once again, everybody, this is my personal example of how I have my portfolio set up. I'm sure there's many of you out there thinking, well, this is great, but it's a little bit more complex than I want to have it. And that's completely fine. And that's the why I gave the example of the core and satellite with, the 5-year and 20-year here in M1 Finance, really keeping it incredibly simple. And I think the majority of people watching this video are probably better off to at least start with a simple model like this. And then if they want to dabble into something like this, and get really, really, really nerdy, then you can do that. But I guess the last thing that I would say is follow your own intuition, know what's right for you. If you want to keep it really, really simple and really, condense it with just a few, go for it. And if you really are maybe an engineer or you want to overthink it like myself or get really into the weeds, you can do it, similar to this. But it really comes down to what's best for you. Thank you so much for watching, everybody. I hope that this video was helpful. I hope that you learned something new, and I'll catch everybody in next week's video.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.